Yo, what is going on, you guys? Hope everyone's having a wonderful day. Today I'm going to go ahead and jump into a video that I think is very helpful for a lot of beginners when just jumping into trading or investing. A lot of times I'm being asked, Jerry, how much should I start with? How much do you recommend starting with? And realistically, we're all different individuals. You know, getting into the space, it's understanding really your situation, you know, your financial monthly income, your financial monthly expenses. You know, we all have different, I guess you can say, financial situations. And with working with so many clients, you know, I've been able to see how each financial situation is able to perform and risk differently in their own journey. So today I'm gonna go ahead and kind of share with you guys my blueprint that I share with all of my clients to help them kind of understand what it is they should be risking and how to navigate it specific to their financial situation. So this is my intro to personal finance, and I hope you guys enjoy this presentation, and thank you for giving me your time and all the support here on the channel. So let's go ahead and jump right into it. So what is personal finance? You know, this is the skill set of managing your own income. And I highly recommend you pick up on this very young, because when you pick on it very young, you begin to now understand more so. You can say, when you are beginning to develop as a young adult or going into adulthood, maturing, looking to maybe acquire your first home, you know, maybe you already have a children and you want to begin to provide for them in their future, saving for their college, saving for just a savings account, or maybe investing in their Roth IRAs while they're young. Different components of life begin to get thrown at us while we mature, where we realize our money is very essential to how we live. Our stress levels, you know, are we living month to month stress constantly, or, you know, really what we can achieve as a reality? You know, a lot of people sometimes don't have the income to begin believing in maybe acquiring their first home or buying a really nice home one day, you know, and it's difficult. It's a big aspect of life. So as you develop, as you begin to become more conscious of the fact, you know, how life correlates so much to your income and really your finances, I recommend you adapt to this very soon. So managing your money to achieve your financial goals, you know, there's three things that you can do with money. It's either save it, invest it, or spend it. I often tell my clients that many people spend their income. You know, as a young adult, we always kind of work to seek some sort of gratification for our efforts. And that happens across so many of our lives, right? Even not just for our wants. There's also times that we need to spend gas, food, rent. We have expenses, right? So learning to kind of combat these expenses with playing what I call offense with your money, using it to make more money. That's the investing side, you know, and this is a skill set. It's a very important one to begin to learn and incorporate in your day-to-day life, because growing money is pretty important. It helps take a lot less stress off of yourself physically and mentally, allowing you to disconnect and create more forms of income that might be some passive. So investing is a great way to kind of take the pressure off of you, begin to push some back, you know, fight back. Now, the next one is saving. This is your defense, you know. This is where you begin to put some in the piggy bank, you know, save some income to prepare for a worst case scenario. Prepare for, you know, maybe financial hardships. And many times while you're young or while developing, you know, maybe we've all found ourselves in some sort of financial pickle. And man, if we had those savings, it sure did help. And when we didn't, we felt the, you know, consequence of that. So learning to separate your income into now your investing, into your saving, into your spending, this is beginning to now develop yourself to understand how to use your income. And it helps you now when calculating your expenses and your income, that we'll jump into the next slide. Learn to percentage this out. Participate in every single category of what money is used as their tools. Because you do have to spend. You have to enjoy your life. You have to gratify yourself for your efforts. Enjoy the fruits of your labor. But investing helps you now take the pressure off, reward yourself more so. Instead of spending, you know how to utilize money to make more, making you a very valuable individual. And saving, have the discipline, have the commitment to know how to prepare yourself for the unexpected. Prepare yourself for what we don't see, right? Key areas of personal finance. Personal finance encompasses budgeting, saving, investing, and credit management. These pillars work together to help you take control of your money. Credit management is the one that I really kind of briefly jump into here, but as a young adult, developing your credit by maybe financing your vehicle rather than buying it outright cash, one great way of starting to introduce yourself to two lines of credit and beginning to make payments, building up your credit history for larger loan amounts. Some of these vehicles some people might be financing for their first car will be roughly $15,000, $20,000, maybe for some $8,000 to $10,000, right? This helps you as an adult mature, and now when you come to buy your house, when you come to, maybe pull out that dream truck or, take a next step in maybe investing in your education, you're going to have higher chances of getting approved for these loan amounts because of your credit, because of your credit history, because of your credit limits, your credit lines. And it's something to become conscious of. Unfortunately, schools didn't really teach us about this, so you want to pick up on this too. Now, I'll go ahead and share with you guys a little bit more in the presentation how that works, but why it matters. Understanding personal finance provides financial security, reduces stress, and enables you to plan confidently for your future goals. More importantly, retirement. This is one that I highly always kind of advocate for. Plan for your retirement. Me growing up in my culture, we were raised in a lot of these blue collar, physically demanding, environments. And majority of those guys out there don't really have too much backed up for them, too much investments, too much savings, planning for that day. So while you're young, whether you are in a great financial situation or a bad one, always think about putting at least a penny for yourself long term. And your future goals, buying your home, buying that dream car, opening that first business, buying that nice wedding, like so many different components that we all dream of as individuals to be able to one day achieve. Hey, monitoring your personal finances, taking care of yourself and your money is a great way to start, So the next one, let's go ahead and jump into it. Budgeting and saving. This is the key component that I mentioned earlier. Your income to your expenses, knowing exactly how much you are making every dollar. Businesses such as even the advanced levels like Meta, Amazon, Google's, Tesla's of the world, their accounting is down to the pennies. So why wouldn't yours be? We're trying to achieve as much as we can, make as much as we can. So let's tighten up the loose screws here. Let's really calculate ourselves as a business to be able to truly calculate what is our 6-month gross? What are we looking at in our investment portfolio? What are we looking at for our savings? What are we looking at and how much we're spending in the next 6 months? We can now have projected numbers because we've calculated for these unique, I guess you can say, scenarios, right? Monitor every dollar coming in and out. Use apps or spreadsheets, which are very helpful as well, to categorize spending and identify patterns that help you make smarter financial decisions. Oftentimes we forget how technology can be helpful. On your phone, budgeting apps. Hey, if you spent this much, take a picture of the receipt. Nowadays they'll log it for you, even help you out in taxes later on. Become more aware of your own personal accounting, right? And this is going to help you catch where it is you're spending money on maybe you shouldn't, and these apps collect it like data and begin to filter out and give you more in-depth analysis than just some receipts. And this is where you begin to really shift it, and hey, some people oftentimes are a bit unorganized with this. They don't find it too important. Jerry, why am I watching this? Why am I doing this right now? Like, I already do that already, Jerry. A lot of times when you ask people, how much are you investing a month? Oh, I don't really invest every month. That's probably a little bit shaky that you're not, because you want to be playing offense on a month-to-month basis when you do receive your income. Or if you're paid on a commission basis, you want to be using your money to deploy it for more on a 30-day basis. So now you have recurring, right? And this is why I tell people, take it extremely serious. It's not something that you want to begin to not, I guess you can say, treat as a priority while you're young. Because when you're older, you're just kind of letting a log fall out of these loose ends. And I've learned in my life that it truly does help to just, hey, it takes a little bit of time, takes a little bit more self-awareness. It's a little bit of a hassle at first, but when it comes to taxes, especially when you're getting into trading and investing, you want to have all of this. It's much more easier, and really just kind of shows you, how you're maturing as an individual. When you start picking out your needs more than your wants, and now using your wants instead for materialistic items, or just those wants, you're using them for offense and investments, the mentality changes. It's not I'm saving to buy things, or I'm working to go buy or do this. It's I'm working to invest to make this. And it's changing so much psychology up there that really does push it to the next level for, I believe any individual that goes down this journey of really taking your personal finances extremely serious. So create a realistic budget that prioritizes your needs over wants, like I just mentioned. Build an emergency fund covering 3 to 6 months of expenses, and automate your savings to reduce unnecessary spending. So now you're seeing automation, incorporating these helpful tools. Hey, some people don't have that discipline really, to pitch it away. So make these recurring for yourself. You can use your banking apps. There's, different websites that can potentially charge you. So now everything in your expenses is already taken care of, and now it's all just fixed, plug and play. You already have your income coming in, you have your expenses being taken out automatically, and now giving you your disposable income. So, what I always tell my clients when we work is track your income and expenses. Write it down on a piece of paper. It's okay. Bring out a piece of paper right now, get a pen, write out your income. Oh, what are my checks at? What are my commissions at? What am my business making me? How much income do I really have? And I recommend my clients do this every quarter. So now beginning, Q2, hey, grabbing a pen and paper, boom, this is my income. This is what I'm making from my side hustles, my businesses, my job, my commissions. Writing it down, boom. Next is my expenses. What am I paying for my business's rent, or my mortgage, or my food, or my gas, or my cars, and my insurance, Different individuals have different expenses. Account for these. Begin to write them down, see them, right? And then at the end, write out what that number is, the difference. What is your expenses to your income? Now with that disposable income, what we know it as in economics, you want to be able to use it to do the 3 tools of money. Invest it, save some, prepare for that worst case scenario, and also spend it. Enjoy it, I highly do advocate for enjoying life while you're young, or when you're older. Appreciate the essence, appreciate, going out to a nice dinner, appreciate, that home-cooked meal, your own groceries, your own home, maybe upgrading to a more luxurious living, little by little, moving up to see what the beauty of this world has for you, So yes, spend it. But now you want to do all of this with calculations, moderation, and more while you're young, even, pivoting to a long-term thought process. And we'll jump into the psychology of investing later. And this is why primarily I recommend all of my clients that work with me push for more investing, because this allows you to now compound young and work less later instead of the flip. Enjoy young and work a little bit harder later for the majority of us, right? And this is why I tell people sacrificing is a psychology, investing is a psychology, and we'll see that on the next slide. But now once you calculate your disposable income, you have to begin to do some mathematics. Break it down to that 40%. Now you have your 40% total for investing on a 30-day basis. Calculate that 30 and 30, for saving and spending. You have everything calculated out. So now when you account for your disposable income, 30% is here, 30% is there. Now we're at 60% for saving and spending. Boom. 40% for investing. Now we have accounted for our full 100% of our disposable income. We know with the 6 months, let's multiply this 30-day basis by 6 months, by 12 months. We know how much income we have and how to, okay, this is what we're doing. So we know if our investments are compounding at a 10%, this is how much we're going to have in year 1, in year 2, in year 3. And you take it further, allowing you to project growth. And this is an important skill set that the normal individual doesn't really know and take too serious. And I'm telling you, it's a little bit more discipline, but it's well worth it. Now, let's jump into the investing basics. Jerry, you know, I got my numbers. I know what it is I have for savings, what it is I have for income, what it is I'm spending. But where do I put it? What do I do with it? I know what I got. I know the numbers, but where do I put them? And this is very important that you begin to separate yourself across accounts, begin to establish yourself with the tools that are available to you, you know, and many people oftentimes don't use these. So building wealth through smart investment strategies, you know, start early for this compound interest. Investing time is your friend, not necessarily always money. And this is huge. This is a concept. This is a philosophy you have to understand. Time is your friend in every scenario in this precious life. It's not money. So for many individuals that are just starting, you know, maybe that financial situation isn't there yet. You know, you're in your early teens, your early 20s trying to get it going. Maybe you're, you know, picking it up in your 30s, 40s, getting it going. But you want to begin just offense. I know some people are more traditional. They go to businesses, they go to gold, and they stay away from, you know, the tools of the stock market. I just recommend you just treat it as another asset, understanding assets versus liabilities, right? And young, developing, it doesn't matter, you know, just starting sooner is going to be your best friend. So time is your greatest asset. The earlier you begin investing, the more your money can grow through compound interest, which is a concept that I'll go ahead and jump into you guys here on one of these slides. Turning small contributions into significant wealth. You know, people often think, Jerry, I don't have thousands of dollars. Don't you need a lot of money for that? You don't. You just need a start. Then you see the reward. You see it play out into fruition. You know, I remember my first investment, man, was at 18 years old, and it was in the rush of crypto. Bitcoin was around maybe 60,000, 40,000, I believe, and Ethereums were going for $1,200 a pop. And I was just starting saving up my checks, but I was like, I gotta get my feet in this. I have to be a part of this, right? And I went and bought my first Ethereum for $1,200. This did two things for me, you know? It taught me that assets were kind of pricey, but when it went good, now maybe 6 months later, when Ethereum went to, you know, 1,200 to now, boom, what, 4.3K? I was like, wow, you know, at the time I had already accumulated 3 of them, and in 6 months I had made 12.9K on my initial 3.6K investment, and providing me, you know, I think roughly like, yeah, 300% return. So it shifted things for me. It taught me, you know, investing takes money. It taught me that the return is behind investing. There is a real concept there. And while you're young, you know, picking up on this, it's so helpful because it gives you positive reinforcement to keep on going, right? So start building up that experience, find out that, yo, this works, and it's gonna help you. So diversify across stocks, bonds, and other assets to reduce risk. Understand your risk tolerance and time horizon, and maximize growth with tax advantage accounts like IRAs and 401ks, which are these accounts that oftentimes you're not Roth IRAs, you don't have to pay any tax at all. These are your retirement accounts, and your 401ks are similar. You know, these long-term portfolios that you just add to in the short term, boom, they contribute, bro. Compound interest is the secret that's never taught. So now when we're jumping into setting up these accounts, right? Jerry, I want to have this retirement account. I want to start taking this serious. Well, let's separate everything. We have our high yield savings account. Our high yield savings account is just a savings, but it allows our money to play offense without being deployed into any markets. So it just is a net positive. The net positive isn't significantly high. It's not going to make you rich, but what it will do will protect you from inflation. So right here we have a negative 2.8 current interest rate. That interest rate is my form of definition of inflation. When you look at what inflation is at, that's what your negative kind of interest rate is against you at all times in your dollar amounts. So you know that the current interest rate's at negative 2.8. You want to diversify yourself into an asset that's either going to perform at 2.8 or higher than 2.8 so you can outcompete inflation and your money doesn't lose value as the cost of goods goes up. Psychology lessons that you want to learn, right? So deploying maybe around 15% of your savings. Remember, we have 30%. You know, when we went ahead and broke down our savings, we have 30% as a whole. So half of your savings going into this high yield savings account, boom. Just protect it from inflation, let it grow. This isn't going to make you rich. Just save it there and treat it like dead money. Money you put in here, you never have the intentions of putting it back out. Now let's go ahead and jump into your Roth IRA. Your Roth IRA is your retirement account, the holy grail, the mecca of it all. When you're 55, 60, this is going to be your baby. You know, this thing's going to print like, man, the best asset you're ever going to sell because you don't pay any taxes. You know, trading stocks, buying stocks for the long term, trading options, exposing yourself to the stock market does lead with a tax on every investment. Roth IRAs are different. They allow you to invest a maximum here in California is $7,500 a year. Once you invest at $7,500 a year, you're done. But this is your annual tax investments that you're going to save. And now, later on, compounding, right? The average APY on a Roth IRA currently is around 10%, roughly. Maybe it could go down to 7, but you'll probably net average 10%. This 10% compounding for you maybe throughout your early 20s into your 30s, maybe late 40s, even early 50s. The result, extremely exponential. And many people really, like I said, take it early, start it early, because it's going to give you that exponential growth. And it's just a tool that you use for when you're ready to retire. There's no taxes. This is mine to keep, my share, it's my sacrifice. I earned it. Boom. Great tool. I recommend everyone use it. You can set these up with Fidelity. I recommend using it, maybe incorporated with your broker. There's different tools. You know, just do your research on them. Speak to a financial advisor if you need to. I oftentimes just recommend people just go to credible brokers for these accounts. Individual investing account, here represented by the acronym IIA, individual investing account. These are where you're going to be buying through your brokerages, whether it be Robinhood, Webull, Charles Schwab, I don't know, what is that, Binance, you have Moomoo Financial, options all across the board. International people use different brokers as well. Your stockbroker, where you access the stock market from, is going to be your individual investing account. It's a tool that you're going to use to try your best to outperform the bare minimums. The bare minimums are this positive 3.2% interest rate in your high yield savings account and the average 10% APY here on your Roth. So once you put in your half and half of your savings to deploy for retirement, half of your savings to deploy to just combat the current interest rate, the remaining of that 40% investing, you want to allocate it to long-term investing, and you want to play with something maybe more aggressive like trading, whether it be stocks or stock options, or, you know, I don't want to jump into too many different assets, just the ones I can kind of help guide you guys with. But usually stocks and stock options, they're great for both long-term performance and, I guess, contributions, and also short-term trading, a little bit higher risk but much higher reward for less capital, making you exponential returns compared to long-term just shares. And allow yourself to be more long-term, more so planting seeds for your future. You know, seeds, trees don't grow overnight. Trees sometimes take years to mature to their full lifespan, and that's how you want to view investing. You know, just plant it in the ground, watch it grow. So long-term investing, you want to have your 40% investing. Go ahead and do more mathematics. Bring that number down, 40% of that number. Now multiply that by 0.60 to give you 60% of the long term. And that's what you want to be having more of a priority for. The long term is a lot harder to lose at. You know, if I were to tell you we would have bought Apple, you know, in the early 2000s, Tesla early 2000, Google early 2000, Amazon early 2000s, the return on our investment here in 2026 would be dramatic, right? And that's the same for a lot of companies in the market right now. But it's long-term payouts. So when you begin to think like that, it's really hard to lose when you pick the right companies. And that's another component that I recommend you get experience and very knowledgeable at when it comes to investing. What is really the look for the future of the company you're beginning to invest in, which is something we help with here at SoCal Trading Group. And now with your short-term trading, you want to have a portfolio for higher risk investments, your option portfolio, what I use, right? To be able to create higher returns, 20, 30% returns in sometimes minutes, you know, exponentials of north of 100% returns, 200% returns in sometimes a few hours. So using these tools Excuse me. So using these tools to be able to now play high reward, high risk, trading more volatile, create way more returns. Now also investing, long-term, patient, 10 years, 20 years down the line, my money's going to be there for me, right? Monitoring these investments too. Not because you're long-term, you just want to watch them sit there, and when they're going down negative 80, 70%, you're questioning, should I still hold this thing, right? Learning how to manage risk is another incorporation that we'll jump into our long-term investing section. This is personal finance. So finally, is your IUL. Your IUL is your asset protection. When you have your assets, your Roth IRA is your asset, your savings account is your asset, your individual investing account is your asset, your home is an asset, maybe gold, maybe, you have other belongings. There's assets that you have to your name. When you're faced with financial losses, whether it be an unexpected medical, emergency, whether it be something chronic that's going to affect you for the rest of your life, something life-changing, right? Maybe, unfortunately, we're all going to be faced with this. Unfortunately, when we pass, there's things that we leave behind that sometimes cost money still. And these cost our families. These sometimes cost the people we don't want them to cost, right? Our houses don't go paid off. And now our families were never in that financial situation to be able to pay for that home. And now we lost our home. These are unexpected things that happen with life, right? And I highly recommend when you're young, you take advantage of this tool of IUL, individual living, what is it? It is a take advantage of, I highly recommend you guys take advantage of a living benefit policy through your life insurance companies. You can oftentimes go get referred from any agents. I don't want to share too many credible insurance agencies here because there's so many. I do have different options. You want to review the terms of these companies and really understand what it is you're getting yourself involved to here. But this is a great start to protect yourself. So God forbid anything happens to you, it's not coming out of your high yield savings. It's not coming out of your Roth. It's not coming out of your individual investing account. It's coming from your asset protection, your life insurance policy to cover maybe $250,000, $500,000. Some people have $1 million policies when, hey, all their assets were, maybe north of $500,000. They paid off all their assets and left their family still another $500,000. Just something that you want to have in place for yourself for that worst case scenario, not just as an investor for the long term, but more so for what you have in the short term, the people you hear, you're with and you love, the people that you're here with and love. I highly recommend you think about that. And now you have all of these accounts set up, having your full income separated into your high yield savings account, your Roth IRA, your individual investing account, and your IUL, utilizing these tools. So now let's go ahead and jump into the final components here. Taking control of your financial future. Your journey to financial freedom starts today, and it's important, man. This is a lot of information, right? Different perspectives, like you're seeing the picture now, and everyone's going to view this a little bit differently, right? We all have different interpretations, different understandings, different psychologies that impact the way we perceive things. So I hope I'm able to translate the worst case scenario and the situation that I believe, while we're young, we have to become more aware of. So review and adjust your budget monthly to stay on track with your spending. When we're young, we kind of maybe are overspending, or maybe we just are overspenders as a financial habit that we've developed across the years. Begin to lower that to allow yourself to play offense. Remember, it's a short-term sacrifice for a long-term reward. Practice conservative long-term thinking. Investing is a mindset. Remember, wants versus needs. And I'm always going to tell you guys, investing is a mindset. It's a skill set that once you incorporate with the mindset allows you to do it exponentially, making yourself much more financial returns, And it's a tool I promise you won't regret learning. So incorporate it. Educate yourself continuously about money management through books, courses, and trusted resources. Seek professional advice when needed. Monitor economic conditions, monitor market sentiment, market narratives, stay informed. Once you put your money in the market, doesn't mean I bought some shares when I was 20 and I held them forever until I was 60. Some of these companies might be gone when you're 60. They might go out of business. They might have faced competition and lost their throne to someone else. Monitor your investments. Bro, we can have a black swan event, we can see the ultimate financial collapse of the entire system, and boom, just like that, all your investments could go down to zero. Be conscious of this and be monitoring markets. Be monitoring markets. You know, a lot of people I see sometimes just let it ride, hold for the long term because they have that security with investing, right? This is not just a sit and it'll grow. For the vast majority of times it could be, but be prepared for when it's not, you know. Be an active investor. Understand market sentiment. Understand market narratives. What is the market leaning towards? What sector are they more engaged in? You know, we see the tech sector, a huge boom right now. A lot of money is in the tech sector. You don't have financials up. You don't have energy. You don't have consumer cyclicals up. You know, this is huge to be informed on what the market's picking as to where the money's flowing in it and being a part of that. What are market narratives? What are these bubbles? What are these, you know, doubts in the market, these positive beliefs in the market where people are allocating their income or taking their income out that I should be aware of, right? Start small, but stay consistent. Small steps today lead to big financial wins tomorrow. Your commitment to these habits will transform your financial life. Sacrificing young pays big when you're older. And this is something I'm always going to tell you because it's not about the money. The financial situation, it'll come as long as you work towards it. You have the right mindset. You wake up every single day grateful and continuing to pursue for more. But the sacrifice of your financials to be able to play offense, it helps so much more when you begin to develop when you're older. It works for you. In the book that I read and I highly recommend all of you guys check out, Rich Dad Poor Dad, he quotes, "The rich don't work for money, money works for them." And it's very, very beautiful to hear that at a young age or just any time in your life because it brings you a different perspective to things can be different if I learn the skill set, if I learn the tool, right? And I highly, you know, I advocate for this all the time, bro, because I see how the education system really doesn't share this too often. So I want to share this with you guys. Credit and debt management. Your credit, man. I told you guys I was going to cover this briefly, right? So when we're jumping into credit, it's a really beautiful tool for you to use. It's there for you when times are good. It's there for you when times are bad, but you have to be disciplined. You have to know how to use it. You have to know how to grow it. You got to know how to be mature here, right? So I highly recommend all of my clients start their high yield savings account with American Express. This allows you to build a financial relationship with them. Do they really notice it? Sometimes they do, you know, when you go to apply. But how we kind of ease our way in here is building up this savings account to then use as a deposit towards a green card. While you're young, getting, you know, your first credit card with maybe Bank of America is great. It's going to help you, but you want to start adding different credit cards, increasing your credit limit, your credit balance. Hey, if you could borrow $500 from Bank of America, you know, $1,000 from American Express, $500 from Chase. Now, instead of just borrowing $500, you have access to now $2,000, right? And this is the very basic numbers. These get bigger. They go up to $50,000. Some people I know have $1 million credit limits just because they learned the skill set when they were young. They learned how to build up their credit history, build relationships, right? And this is huge. So starting off with an American Express green card allows you to deposit money and now use that money as a credit. They'll view it and how often you pay it back, how you manage it, where you spend. Later on, once you build up your credit and you maybe build some credit with Bank of America, Chase, and maybe you're now, you know, pushing more into the positive side, you can apply for a credit card with American Express, giving you more access to funds and really good access to giving you a really good credit card company on your side. This is a company that goes above and beyond for their clients. It's a little bit more towards the higher end of, you know, credit companies, but it's wow, nothing like many, bro. Bank of America does not cover what American Express covers, and yeah, I highly recommend all my clients get very sophisticated and get the best when it comes to building their relationships with certain credit issuers. So maintain low credit utilization. So let's say you have a credit limit, you're young, getting started of $1,000. Hey, you do not want to be using 50-60% of this $1,000, pushing your limit, you know, using how much, $500-600. You don't want to use that much. You want to sometimes just borrow $100 for dinner, you know, another $100 for my gas. Pay my dinner, pay my gas, boom. Hey, this week I need groceries. Hey, boom, 300 for groceries, paying it back, boom. And now you're only pulling at maybe 20-30% of your credit. This shows credit issuers, you don't really need my money, but you're good at paying what you do take. Hey, if you need some more, I trust you. You've been able to pay me, I always wanted to give you 1,000, but you only take 200-300 and you always pay my money back. So, hey, if here's 5,000. If you ever want to go, spend some more, you can. Building up your credit relationships with low credit utilization shows responsibility. Monitor your credit reports. Use a Credit Karma, use Experian. Look at what it is these bureaus are reporting about you. Make sure that it's, keeping up with your monthly payments and you're up to date. So use your credit for needs, not wants. When people jump into credit, sometimes they want to start buying things that they really can't afford, buying things that are more luxurious because they have $1,000 that they have there that they can just pay back later. Don't run into that psychology. Build yourself more maturely, more, I guess you can say, just responsibly, right? Sacrifice yourself. Know that these are for needs, specific groceries, maybe those vehicles that we need to get a point A to point B. Don't go, trying to buy a boat on your credit card, some jet skis on your credit card, just while you're young. Establish yourself first and then look for wants. But focus on using your needs to build the utilization, to build the history, to build the relationships. Later on, assuming you increase in your financial situation, hey, you can afford some wants, and it's not coming out of your pocket, probably at a way lower interest rate than you would, maybe just paying out of pocket, and it's a tool now, Many people finance vehicles because they don't necessarily know what's going to happen. They don't know if they're going to get hit. They don't know if it's going to be worth more or less, so they finance it. When it's a depreciating asset, once you buy the car, it gets miles, it needs oil changes, brakes, gas. So why am I going to pay a full $50,000 out of my pocket for it to go negative when I can finance this vehicle and only pay $500 a month? Something goes wrong with it. Hey, insurance takes care of it. That's one simple concept where financing is better than paying outright and allowing you now to, hey, keep your capital that you worked so hard for safe, using it smarter. And that's where credit really steps in. Bad habits, everyone, we're going to run into them. Missing payment deadlines, carrying high credit card balances, ignoring debt accumulation, risk, high interest rates, credit damage, and stress. Once you use this tool incorrectly, it can creep up on you and fast, and you will feel it. So be careful, be aware, be responsible, because when you begin to mess up, it really does accumulate, and it's something that you want to be aware of. That's why I tell everyone, keep your utilization low, be very responsible. But credit does go hand in hand with your investments and your financial income and your personal finances, as it is what we're going to be using to make higher purchases. Many of the biggest companies in the world are borrowing money for expanding, are taking out of their continuous cash flow. So understanding this concept and understanding now this psychology, it's very important stepping into investing and trading that you understand all of these, because it's laying out the groundwork. So when you are playing long term, when you are playing stock options, you have everything accounted for, and you know what vehicles you're using to protect yourself as an all-around powerhouse. So I hope you guys enjoy this presentation. It's one that I've been working on for quite a while. I hope to share a lot of knowledge and information with those seeking it and really here to value it. Thank you guys for giving me all of your time, and welcome to SoCal Trading Group, and thank you guys for supporting all the channel. It's a really depth gratification I have for you guys, because it's wow, an experience to make these videos and people actually watch them. Try it. Post a YouTube video, bro. 2-3 people will watch it, and later on some people will watch some more, and it builds, and to watch that means a lot to me, and I truly, truly say thank you. And I hope this is able to help someone. You know, when I was young, no one taught me this, so I hope it's able to help you guys push it further, right? So I hope all you guys enjoyed this video, and welcome to SoCal Trading Group once again. Thank you, and let me know if you guys have any questions or concerns in the comments. Hope all you guys have a wonderful evening. Jerry Trades, SoCal Trading Group, over and out.